Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Retail Credit Risk. Retail credit risk refers to the potential for losses due to borrowers failing to meet their credit obligations. This aspect of credit risk management is crucial for financial institutions as it directly impacts their profitability and stability. Retail credit risk encompasses various forms of lending, including credit cards, mortgages, auto loans, and personal loans. Effectively managing this risk requires a deep understanding of borrower behavior, economic conditions, and the application of advanced risk assessment models. One of the fundamental components of retail credit risk is the assessment of borrower creditworthiness. Credit scoring models, such as the FICO score, play a pivotal role in this process. These models evaluate a borrower's credit history, outstanding debt, length of credit history, new credit, and types of credit used. Higher credit scores indicate lower risk, while lower scores suggest higher risk. According to Fair Isaac Corporation, as of 2021, 16% of Americans had a FICO score below 580, which is considered a poor credit rating. This statistic underscores the importance of accurate credit assessment in mitigating risk. Advanced statistical methods and machine learning algorithms have enhanced the predictive power of credit scoring models. Logistic regression, decision trees, and neural networks are commonly used techniques. These models analyze a vast array of variables, including transaction history, employment status, income, and even social media activity, to predict the likelihood of default. The integration of big data and artificial intelligence has significantly improved the precision of credit risk assessments, enabling lenders to make more informed decisions. Economic conditions also play a critical role in retail credit risk. During economic downturns, unemployment rates rise, disposable incomes fall, and borrowers are more likely to default on their loans. The 2008 financial crisis is a prime example of how macroeconomic factors can exacerbate retail credit risk. During this period, mortgage delinquencies soared, leading to substantial losses for financial institutions. According to the Federal Reserve, the delinquency rate on residential mortgages peaked at 11.54% in the first quarter of 2010. This highlights the need for lenders to consider economic indicators and stress testing in their risk management strategies. Stress testing involves simulating adverse economic scenarios to assess the resilience of a lender's portfolio. By modeling the impact of variables such as unemployment rates, interest rates, and GDP growth on loan performance, lenders can identify vulnerabilities and take preemptive measures to mitigate potential losses. The Dodd-Frank Act stress test and the Comprehensive Capital Analysis and Review are regulatory frameworks that mandate stress testing for large financial institutions in the United States. These frameworks ensure that banks maintain sufficient capital buffers to withstand economic shocks. Another crucial aspect of retail credit risk management is the monitoring of loan performance. Continuous monitoring enables lenders to detect early signs of distress and take corrective actions. For instance, a sudden increase in credit card utilization or a missed payment can signal potential trouble. Lenders often use risk-based pricing strategies to manage credit risk, adjusting interest rates based on the borrower's risk profile. Higher-risk borrowers are charged higher interest rates to compensate for the increased likelihood of default. Loan restructuring and modification are additional tools used to manage retail credit risk. When borrowers face financial difficulties, lenders may offer options such as extending the loan term, reducing the interest rate, or deferring payments. These measures can help borrowers stay current on their loans and prevent defaults. However, loan modifications must be carefully structured to avoid moral hazard, where borrowers may deliberately default in anticipation of more favorable terms. Securitization of retail loans is another practice that affects credit risk management. By pooling loans and selling them as securities, lenders can transfer a portion of the risk to investors. Mortgage-backed securities and asset-backed securities are common examples. While securitization can enhance liquidity and reduce risk for lenders, it also introduces complexity and potential systemic risk. The 2008 financial crisis illustrated the dangers of poorly understood and inadequately regulated securitization practices, as the collapse of MBS markets triggered widespread financial instability. Regulatory frameworks play a vital role in ensuring prudent retail credit risk management. The Basel III Accord, developed by the Basel Committee on Banking Supervision, sets global standards for bank capital adequacy, stress testing, and market liquidity risk. Under Basel III, banks are required to hold higher levels of high-quality capital and maintain robust risk management practices. These regulations aim to enhance the resilience of the banking system and reduce the likelihood of financial crises. Consumer protection regulations also impact retail credit risk management. Laws such as the Fair Credit Reporting Act and the Truth in Lending Act in the United States ensure transparency and fairness in lending practices. These regulations mandate accurate reporting of credit information, clear disclosure of loan terms, and protection against discriminatory practices. Compliance with these regulations is essential for maintaining consumer trust and mitigating legal and reputational risks. Technological advancements continue to shape the landscape of retail credit risk management. Fintech companies are leveraging technology to offer innovative credit products and services. Peer-to-peer lending platforms, for instance, connect borrowers directly with investors, bypassing traditional financial institutions. While these platforms provide new opportunities for credit access, they also introduce new risk dynamics that need to be carefully managed. The advent of blockchain technology holds promise for enhancing transparency and efficiency in credit risk management. Blockchain's immutable ledger can provide a reliable record of credit transactions, reducing the risk of fraud and improving data accuracy. Smart contracts, which automatically execute predefined conditions, can streamline loan agreements and enforcement. However, the adoption of blockchain in retail credit risk management is still in its early stages, and regulatory and operational challenges need to be addressed. In conclusion, retail credit risk management is a multifaceted discipline that requires a comprehensive understanding of borrower behavior, economic conditions, advanced risk assessment models, and regulatory frameworks. Accurate credit scoring, continuous monitoring, stress testing, and loan restructuring are essential tools for managing this risk. The integration of big data, artificial intelligence, and emerging technologies such as blockchain presents new opportunities and challenges. By adopting robust risk management practices and staying abreast of technological and regulatory developments, financial institutions can effectively navigate the complexities of retail credit risk and ensure their long-term stability and profitability. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.